The U.S. Bureau of Labor Statistics released its jobs report for July, and it shows the unemployment rate holding steady at 3.7%. Here's a live look at the markets. The Dow Jones is down. This might still be from the China news.
Yeah, for sure. I mean, the markets in Asia were down significantly overnight. And so now you're seeing some of those weaknesses here in the Dow, down about 100 points. So let's get straight to Yahoo finance reporter Scott Gamm. He's joining us to help break down what we're seeing. So, Scott, the report is more than just that unemployment number. What's the biggest takeaway?
Well, that 164,000 headline number was better than expected, but you also want to watch average hourly earnings. This is how much money people are making. That was up 3.2% year over year, which was more than what Wall Street was expecting. Even the month over month number was more than what people were expecting. So people are making more money. Now, what that means for the market is unclear, just because when people make more money, that hurts corporate margins, which could eventually hurt stock prices. But overall, this was a solid inline report with what the market was expecting.
Scott, does this number surprise you at all? And how did the market react to the jobs number versus the interest rate news from earlier this week?
Well, that's a great point, because it's going to be really hard to isolate any of the market action we're seeing today, just because you've had so much going on this week, from, Apple's earnings on Tuesday to the Fed cut on Wednesday and that volatile press conference from Jerome Powell. And then, of course, those tariff announcements yesterday from President Trump. So I think the market is trying to digest all of this. I think this market wants more rate cuts, and the big takeaway from this week is that if we do see more tariffs, perhaps that raises the chance that the Fed would be more willing to go ahead with more rate cuts. And that's something this market has been demanding for quite some time, and we certainly learned that this week, just looking at the market reaction that we saw on Wednesday after Powell addressed reporters at that press conference.
And one of the reasons to cut the interest rate is to try to stimulate the economy because of concerns that it is slowing. What does the jobs number say about the possibility that there's a slowdown?
Well, you kind of have two economies going on right now. You have a strong consumer, hence these good hourly average earnings and the strong jobs numbers, but then you have some weakness in manufacturing. If you look at some of the data there, you're seeing some weakness. So it's kind of hard to get a full picture of what's going on. And I think that's one of the worries of the Fed, is maybe they just want to get ahead of any weakness that might be coming up by doing what's called an insurance rate cut. And you can argue that's what they did on Wednesday. But we know this market wants lower interest rates because it makes stocks more attractive. So, of course, the market is demanding even more rate cuts from the Fed, perhaps as a hedge to what the Fed did last year, which was raising interest rates 4 times, which many view that as sort of an unsustainable path.
So let's dig into some of the historical numbers, Scott. How do these job numbers and the growth in jobs compare to President Trump's last 4 years in office? Give us a sense of President Obama's last 4 years in office. Give me a sense of President Obama's job growth and the policies that have led to job creation and growth under President Trump.
Well, certainly since the financial crisis, job growth has remained steady. We've been creating jobs largely every month over the past 10 years or so. And obviously that covers 2 different administrations. Now, anytime you have such growth for that long a period of time, 10 years, you have people wondering how much longer this can go. And certainly, last year we would see job creation per month, 200 to 300,000 per month. And now we're seeing a little bit less than that. And so you have to wonder just how much longer this economic expansion can go. And again, I think that's going back to what the Fed is trying to figure out as well.
You mentioned earlier that a cut in interest rates makes stocks more attractive. Can you explain a little bit for the average American? What does this really mean for them in terms of what they might be able to get in terms of their returns in their savings accounts, mortgages, just anything that they buy in terms of consumer goods?
Well, absolutely. When the Fed cuts short-term rates, it has this sort of domino effect. So eventually you'll see interest rates on savings accounts and CDs come down. You'll also see interest rates on bonds largely come down over time. And so for an investor, you're wondering, well, why am I going to put my money into a bond or a savings account when it's not getting much of a return? Instead, maybe I'll take on some extra risk and put my money in stocks. And so that extra stock demand could fuel stock prices. And so it's all relative. That's that's why investors want lower interest rates, because it kind of keeps more investors into the stock market and keeps stock demand higher.
But if you're a bond investor, you're not liking this.
Well, yes. I mean, certainly interest rates and bond prices move in opposite directions. So it kind of depends when you're selling the bond and when you're buying the bond. But I think overall, I mean, you look at the 10-year Treasury yield, which is kind of the benchmark health indicator for the overall economy. Yesterday, that fell not just below 2%, but below 1.9%. That was the lowest level since November of 2016.
All right, Scott. Always great to have you, my friend. Thank you very much.
Thank you.